All right, welcome to the NZ Everyday Investor. Today, we're talking about the biggest risk to property prices in 2022, and specifically some of the unintended consequences of the triple CFA. So my special guest today is John Bolton from Squirrel. How are you, John?
G'day, Darcy. Good, mate.
Excellent. Let's get stuck into it. What is the triple CFA?
So triple CFA is a piece of government legislation that's designed to protect consumers from predatory lenders, from high cost finance, and but it covers everything. So it covers all lending to consumers.
So that's kind of like the letter of the law, but what about the spirit behind it? So you kind of touched on that in terms of predatory lenders, but is that actually a really bad problem in New Zealand? I'm sure it is, but is it so bad that this law needs to be spread out everywhere else?
Yeah, look, there's probably a couple of things to touch on. So the first is triple CFA, which is the legislation designed to protect consumers. And then there's another thing called the Responsible Lending Code, which is a code that sits alongside the legislation, and that code is quite prescriptive, and it tells lenders, what they're expected to do to demonstrate that they're complying with the legislation. And a lot of the issues are actually with the Responsible Lending Code, which sits alongside the legislation rather than the legislation itself. And then your question was, how bad is the predatory lending in New Zealand? Well, look, it's there, and it tends to exist at the bottom end of the market. We're talking about things like, these sort of truck lenders that drive around selling product to people in sort of low economic areas, and then they put finance off the back of it. You could argue maybe some in the secondhand car market, certainly payday lenders. That stuff where they were sort of charging effective interest rates of 200 or 300%, charging high fees. All of those sort of things are sort of being pulled back, and I think that's a good thing, particularly where people are vulnerable borrowers, where people don't understand what they're doing or aren't in a financial position to make good decisions. And that's what it's designed to protect. But as I said before, the issue is that in solving that problem, the legislation is actually touching the entire market.
That's kind of what I wanted to really dig into, was some of the negative spillover effects or the externalities. And it's just like any medication, right? It's intended to do something good, but every now and then there's some negative and positive consequences of some medication that gets designed and ends up being used for other reasons in the future that we don't really think about. And it causes other problems that we don't really think about. Now, small to medium-sized businesses in New Zealand, they constitute a huge amount of activity, and a lot of everyday people that are working will be employed by small to medium-sized enterprises. And the biggest kind of concern that I have with this bit of legislation is the impact that it will have on these businesses when they go to apply for credit. So can you talk to me about how, I guess, typical small to medium-sized businesses actually do raise funds for business activity in New Zealand?
So the residential housing market has, a stock value of $1.5 trillion. So it's a value of all residential housing in New Zealand. There's, 350 to 400 billion of outstanding debt and mortgages and consumer finance, which means that, Kiwis are holding $1.1 trillion of their wealth in residential property. A lot of those people are going to be small business owners. Very difficult to get unsecured lending out of banks or, out of high quality finance companies. There are some that are doing it now, for smaller loans and stuff. But, historically, the most cost effective and easiest way to access capital for a small business has been to leverage residential property. I guess that's the risk, right? The risk is it's going to get a lot harder to do that. We're already encountering it. We're seeing lots of situations where, small business owners, irrespective of what they're doing, are starting to run into these triple CFA problems. So the convenient and easy argument would be to say, well, triple CFA's got nothing to do with business, and therefore it shouldn't impact them if it's business borrowing. But that's where it gets a bit blurry, right? Because small business owners, maybe borrowing on the house, maybe directly or indirectly related to the business. So for example, early stage companies, typically they'll leave all of the money recycling in the business so that they can fund their growth. They won't draw on the business, which may mean that they have restrictive cash flow in their personal life, but it's because they're funding growth. But the way triple CFA works, it's not going to see that. It's not going to see that they're funding growth. It's just going to see that they're not taking enough income out of the business to support their debt level. And so they won't be able to borrow on the house. And then when the bank goes to look to the business, it's in a high growth stage, it's not overly profitable, and they're going to struggle to look through that. And so that's where we really start to run into problems with triple CFA.
And naturally, you'd think the triple CFA that's targeting property owners, stop your whinging, move on. Small to medium-sized enterprises, we've just talked about that. Talk to me about how this sort of credit expansion and contraction thing, talk to me about how that kind of moves out to the wider economy, if you can.
Yeah, we've got to address a few issues in here. And the first one is fundamentally house prices are driven by interest rates. And the correlation between interest rates and any form of asset price and housing and even commercial property aren't immune to this, inextricably linked to interest rates. We've had a very big interest rate cycle where, because of controlling inflation, we've had 30 years of declining interest rates. Now, clearly that's turned and interest rates are on the way back up again now. But it wasn't that long ago that borrowers, and in fact, I had a mortgage at one stage at 10%. So we've had a massive reduction in interest rates. And what we find with house prices is that, broadly speaking, Kiwis spend about 40 to 45% of their discretionary income on putting a roof over their head, whether that's rent or whether that's buying property. And if you look at a long time series, you'll find that that's broadly true most of the time. There are parts of a cycle where it blips up and down, right? But broadly speaking, Kiwis spend 40 to 45% of their discretionary income on housing. Now, that's probably quite high globally, but that just reflects, I think, the fact that, for Kiwis, property is just such an important part of their lifestyle, right? We don't eat out like New Yorkers. We don't do the shows. We maybe don't travel as much as some other countries. We really prioritize housing. So what happens is if that's the amount of money, disposable income that we're spending on property, and then the servicing costs on debt decline, that just passes straight through to house prices. And the way that happens is a competitive process, right? So we have got a really tight housing market like we've had over the last couple of years, where there's a real lack of supply, and you've got a lot of people wanting to upgrade or move or do things, and you've got very low interest rates. They're essentially bidding house prices up to this 40 to 45%. Now, if you lower that number, you're going to impact on house prices, whether that's through debt to income ratios, which the Reserve Bank's talked about, or it's inadvertently through things like triple CFA, those things will impact on house prices. And I guess then it's about what's the most effective tool. Look, the first thing I wanted to sort of say was, with interest rates increasing from 2 to 4%, that's going to be a massive influencer on house prices, because that alone significantly reduces affordability. And we've got banks now testing mortgages at 6.5%. A 2% increase in interest rates on $350 billion of mortgage debt is going to take about $7 billion out of the productive economy. So, all of these things are tightening the economy, and arguably that's required because we've got really low unemployment, we've got high inflation, right? So you want to kind of squeeze everything. What will be interesting is whether that inflation is genuine long-term inflation or transitory. There's been lots of debate about that. Everyone's kind of flipping towards it's been transitioning for too long, therefore we've got to deal with it. And interest rates are increasing. Now, the increase in interest rates alone is going to have a really significant impact on the economy, particularly with the Reserve Bank not spending money anymore, printing money anymore, and probably the government having to get a little bit more fiscally responsible. All of these things are going to sort of tighten up on money supply and reduce spending in the economy, and that starts to bring things back to normal. Triple CFA isn't that tool. And look, when we sort of start to talk about the unintended consequences, we touched on earlier about small business. I think the challenge for small business is that we've got COVID, we've got Omicron, we've got all these things impacting parts of the economy like tourism, which is buggered. We've got hospitality, which is buggered. Retail's struggling. Construction arguably is going through this boom. It's got this incredible rate of inflation going on, but it's got massive, driven by supply shortages. Basically, it's got massive constraints on it. We're probably trying to build way too fast for the supply situation at the moment. Higher interest rates will probably help there. But we've got all of these things going on in the economy that aren't necessarily positive. We've got higher interest rates coming through. We've still got border restrictions. There's all of these impacts, and then we're making it much harder for small business to access the working capital it needs to survive, these really, really tricky situations where working capital is just going to be so critical for a very important part of this New Zealand economy.
Yeah, and what you're basically saying though is that the interest rate thing increasing, like almost doubling effectively at the pumps, what we're paying for our money now, that alone can have a tremendous impact to the economy, full stop. But it's the entourage effect, isn't it? It's when you layer on the accessibility to credit, not just the cost of it, but the accessibility to it. That's where it's almost like this picture of every single tool is being thrown at this problem all at the same time. Are we just doing too much all at the same time, do you think?
Yeah, but some of it's unintended, so it's like, increasing interest rates, fine. There are no issues with it. It's a perfect tool to do what it's intended to do, right? Even the LVR restrictions, painful at the moment for first home buyers because it's really hard to get into the market in the short term. But it's a pretty good tool to help slow things down, right? And it will restrict people buying into the market, and that there'll be a lot of people that will be disappointed about that. But it doesn't have broader implications like simply restricting access to credit. And look, the problem with restricting access to credit is that you would sort of say, okay, well, look, that's, maybe there's pockets where that's appropriate. And, you could certainly argue that around vulnerable borrowers, right? But you don't want to restrict credit to the productive economy. You don't want to restrict credit to where it's actually required to support business, but also to support people that are just, doing things in their lives, not crazy things. Not, it's really easy to sort of say, oh, we've got to cut back on this lending because people are buying boats and flash cars and all that sort of stuff. And sure, people do that, and that's their choice, personal choice. But so much of what we see is just legitimate people going about legitimate things, people who may be changing location, moving cities. They need to buy and sell. Unfortunately, at the moment, you've got to buy before you sell. So that creates bridging loan scenarios, which are very complicated, very hard to solve with triple CFA. And, the challenge is that just puts all of the risk onto the homeowner. They've got to take the risk of buying and then hoping that they can sell in time.
All right. Just to interrupt, John. So you're talking about now bridging finance, and this is something that I struggle with all the time. And being ahead of a much bigger operation than what I have, you'll see it in aggregate a lot easier than I can. So let's just maybe take through one or two examples, starting with the bridging finance example of just how the triple CFA stops everyday people from doing everyday things.
Yeah, look, honestly, bridging finance terrifies me. So the problem, there's essentially another issue with triple CFA that's existed for a long time. It's not new, so this isn't something that's changed in the past couple of months. We've been living with this for years. It's just got worse. So triple CFA basically says that lenders can't charge a fee in excess of the cost of performing the credit function in terms of how much does it cost you to process an application and assess it, and that's the only amount that you're allowed to recover in your fees, right? Now that's in the consumer finance space. I actually think that's completely fine. It deals with certainly things like payday lenders charging really high fees for small loans. So, fit for purpose in certainly some parts of the market. But when you apply that logic to mortgages, it starts to unwind. And bridging loans is a perfect example of it, because I had a situation a couple of weeks ago. A retired gentleman was shifting houses, and he needed to buy before he sold, and his house didn't sell. So he had to settle on the new property. He couldn't move the settlement date. He'd given himself a couple of months to get his house sold, and it hadn't sold. He was going into Christmas, and he's retired. So he had good income because he had a private pension. So he could service the debt on interest only. And his house was debt free. So, it should have been a simple transaction. And, none of the banks are touching that at the moment, because you've got an older borrower, vulnerable, triple CFA, can't support the level of debt with income. Now, triple CFA does have an ability to look through that and sort of know that there's a clear exit. And therefore, I think it's bank interpretation of triple CFA that's caused the problem there, not the legislation itself, because they did put provisions in for bridging finance. Where the fundamental problem is with bridging finance is that because it's so short term, and you don't know how long it's going to be for. It could be for a day, a week, a month, 3 months, 6 months, maybe even 12 months in some situations, right? Is that it's very difficult to economically make that stack up based on margin, which is what triple CFA requires. It says charge small fees, make your profit through the margin. But it's very difficult to do that with a bridging loan, right? So because you don't even know how long you're going to have it on the books for.
Yeah, short term.
So what it means is that finance companies and non-banks who maybe have more limited funding and therefore want to prioritize it to things where they can make money, just aren't prepared to do bridging loans. And so what we've got a market that effectively is broken, and that the only cost-effective providers of bridging loans are banks, and banks aren't doing them. And it's fundamentally because the economics of that market are broken, which is not creating competition, and it's not allowing that market to develop. And we're just leaving all of these homeowners in this incredibly vulnerable position, and very expensive if they mess it up, of having to juggle buying and selling property. And it's a nightmare.
It is, isn't it? And like I think about the worst possible time to buy a place before you sell is right when you're at the top of a market. Not that we can ever know when the tops and the bottoms are, but if we were at a top of a market last year, for example, then potentially that's the scariest time to move forward and purchase something, say, off the plans as well as another risk, because you're dependent on lending criteria or lending rules, which are subject to change at any time. And they do change at any time without warning sometimes. In this case, a little bit nuanced, because while there is some provisions in the legislation to carve out a space to be able to do that, like you say, it's not economical, because if you have to do it using that type of methodology, the lender has to have a decent amount of time to recoup their costs, right? So of course they're just not going to want to do it. And it's hard, right? So again, that's a massive unintended consequence, isn't it?
Well, it's a really serious one, because the other side of that is that, quite often in the housing market, sale and purchase agreements are stacked up against each other, and you get these long chains of purchases. So you only need one in that chain to fall over for it to wreck the whole chain. So, again, there's another level of unintended consequence. Retired borrower who was intending to sell in time doesn't sell in time. They can't settle on time. The person that was selling that property has gone and bought another property, can't settle on time. And you just get these chain effects and just all of these unintended consequences flowing through. Now, if the borrower was irresponsible, if the borrower was doing things that they shouldn't be doing, then that's just that's just unavoidable, right? But these are situations that should be completely solvable, and it's just made very difficult by the way that we're regulating the market.
Yeah, agreed. Talk to me a little bit then about buying properties off the plans, especially thinking about people buying their first home and the property is not going to be finished for 12 to 18 months, or maybe they're buying an investment property, it's off plans, or maybe they are doing a buy and sell transaction and they think 18 months is so long away, I can just sell my place closer to the time and I'll worry about it then. Are you seeing a little bit of problems in that space? Is that starting to concern you a bit more?
Yeah. Look, I think off plan, there's a multitude of risks there. And that they get touched on in the media a bit. I think mostly at the moment it's about sunset dates and then developers cancelling sale and purchase agreements. But look, I guess the challenge when you make changes like triple CFA is that people that are buying off plan, often in sort of 1 to 2 year timeframes before they actually have to settle the property, and finance approvals don't last that long, not even close. So the reality is we're going to have to reapply for funding, at least probably 2 or 3 times through that process. Sometimes we think we're going to be okay, and then of course delays to construction mean that we're invariably have to go and get another approval. The challenge there is that when you're buying off plan, you get exposed to changes in credit policy. And look, normally those are pretty small, and the Reserve Bank's been pretty good, because this would have been a terrible situation if new builds weren't exempt from LVR restrictions. And, when LVR restrictions first came in, this is one of the things that we were fighting very early on, was to get new builds exempt, right? Because the impact of that would have been absolutely massive, not just on developers trying to build property, but on all of these first home buyers with low deposits, creating settlement risk. So I guess we've got the same thing again, but this time around it's triple CFA, and it's this, it's these affordability calculations that are causing the problem. I think, Darcy, it's worth just touching on that affordability calculation in relation to mortgages, right? Because
go for it. Yeah.
In relation to consumer finance, it's really simple. You're going to buy a car, you've got some income, you've got genuine living expenses. Can you afford the car? Yes or no? We can still argue around how prescriptive those expense calculations are, but the fundamentals of that transaction are quite simple, right? When we get to mortgages, there's just so much more complexity in there. One of the things with mortgages is, of course, that we're testing servicing ability on a 6.5% interest rate, principal and interest repayments, when the reality is the borrower is going to have a rate of somewhere between 4 and 5, 5 once we sort of start to get to the peak of the cycle. Everyone's talking about the OCR peaking at 3. That's going to be housing rates at about 5. Yet we're still testing them at 6.5. So we're testing them 1.5% above where even the Reserve Bank is expecting rates to peak in this cycle. That's a big fat margin of error, right? That's already priced into these mortgages. Then on top of that, we're putting a very prescriptive and conservative approach across their expenses. And you'll know just as much as I do that, particularly when we get into low deposit lending, banks have got other conservative things that they do. So for example, they won't allow borders for first home buyers. Now, if you're a first home buyer and you're buying a 3-bedroom townhouse, and it's starting to get a little bit tight because interest rates are high, what's the first thing that you do? You'll go and grab a border. And so I think what we've seen through every cycle, and everyone will appreciate this that owns a property, is that people adjust. They just adjust. If interest rates go up, they find ways of cutting expenses, they get a border, they do whatever it takes. And we know that people do that. And the problem with these affordability calculations is that they don't take that into account at all. They don't include they don't allow for that behavioral shift that we know will occur. And it doesn't really factor in just the amount of buffers that are already existing there. The job of triple CFA, I think, is not to really assess affordability. I think banks were assessing it perfectly well before, and all this has done is just put another layer of conservatism over it.
And do you think, though, that it is the legislation that is broken, or the application of that, or the interpretation of that legislation by the banks?
Yeah, look, that's where all the debate is at the moment, right? The government's going to say it's the banks are going to say it's the government. It's a bit of both. I think it would be fair to say, from what we're seeing, the banks have got it wrong. But we've got to put some context around that. Banks are very quickly to get beaten up. They're dragged through all sorts of processes and reviews about how nasty they are. And so, they're inherently conservative, and, they're always going to play the safe game. They don't want to take risk. They're always going to be at the conservative end of it. Other lenders will be prepared to take a bit more risk, and that's why you get a bit of variability in terms of how different lenders are approaching triple CFA. So some of this is the banks, but you can't just blame the banks for that. I think there's a broken relationship there between regulators, the government, and banks. They're good organizations, actually, are really well run, and they're typically doing the right things, and they've genuinely got really good processes around this sort of stuff. Very easy to beat them up, but they're good operators. Unfortunately, when we do get a little bit carried away, these are the consequences, that they do take a conservative approach to these things. But look, on the regulation side, they haven't got it quite right. There's elements of it that are wrong and overly prescriptive, particularly around having to verify expenses that you can't sort of estimate in other ways. So things like insurances and stuff. So we're actually having to, for borrowers now, we're having to provide copies of insurance bills to evidence the amount that they're paying for insurance. Where's the trust gone? So if you have a client that's got a lot of insurance and or properties, or anything really that's insured, suddenly we've just got this massive raft of paperwork to support applications. There's no trust there. We're having to verify everything. When you go into that level of verifying expenses, it tends to blow out much wider. And suddenly it's not just the insurance, but we're having to verify everything. And then we end up in debates around what is discretionary and what is a hard cost. And look, some of those conversations are good, but we'll leave it there.
Yeah, no, I know where you're going there. It is good. Like, it does draw out probably a healthy discussion on just household budgeting and being strategic and reasonable with how you're conducting your affairs. But it's kind of like, in the past, it was tell me what you spend money on. Now it's show me what you spend money on and prove it. And I think in some areas it's just not feasible to keep moving forward, right?
Yeah, well, I think the real challenge is around discretionary expenses. And so, Darcy, the real problem here is wealth, because we're taking a very singular view of this. What we're saying is, you have to live within your means, income less expenses, right? And we go, okay, that's what you can spend. Now, the problem is that, when you're spending wealth, particularly as people get older, that's being viewed as standard expenditure. So I had a situation the other day with a client that's got 12 million of net assets, and the bank was bemoaning them spending $2,000 a month on groceries over Christmas, and because their income less their expenses looked tight, and I'm like, well, what does it matter? They've got $12 million in.
So this is a really important point that you're drawing out here. So you're saying, if you had a massive bank account full of millions of dollars, and that was basically like a property sale or something, it's already the fruits of your labor, and you're spending that to live a really abundant lifestyle, but then you go to the bank and they're going to completely disregard the fact that that money actually came from a big pot over here, and they're going to just look at a source of income and do the calculation based on that. Is that kind of what you're saying?
Yeah. Well, I just had one decline just a couple of days ago. Exactly that scenario. Yeah. No. This is the challenge, because income versus expenses as a definition of affordability is fine when it's simple, but when things get more complex, it's completely wrong. And this is, this is where wealth needs to factor in to these decision-making processes. And if it doesn't, it's going to have a huge number of unintended consequences, because people who have assets are deploying those assets and making investment decisions in a very different way to someone who's, deciding whether or not they're going to buy a car. So it just doesn't work. And this is the problem that we've got, right? And this comes back to this fundamental problem that, $1.1 trillion of our wealth is locked in this property market. And, we're unintended, because I don't think this was the intention, but we're just kind of locking it up and saying, cool, guys, you can't touch that. Good luck.
That's right. So it almost doesn't matter. And that's the weird thing about this, because we always say, hey, of all the different investment classes, and putting your own home aside, but let's just say it's an investment property, of all the different investment classes, property is illiquid because it's hard to divide it up and to sell tranches of that property off in the future if you need to. And the reason why we need banking sometime when we're in wealth building phases, because we need a partner which creates, where it actually financializes our assets so that we can draw out some liquidity. And as soon as we've done that, we're actually shrinking that liquidity, and we're locking down that $1.2 trillion even more. So it's crazy, but I want to keep moving on here, because there's a few more things to go through. And I want to draw on something that I just read yesterday from economist Cameron Bergery. Now, I know that you guys are in agreement for the most part around a lot of these things, so this won't be too controversial, but he said yesterday that we can talk about the triple CFA and its unintended consequences, et cetera, et cetera, et cetera, but someone has got to step in and think about the bigger picture here. An 11% rise in housing debt in 12 months is not normal. It's not sustainable. Income growth has been about 6%. Now, that makes absolutely no economic sense to me. I'll put a link in the show notes for those that want to read the full article there. But what would you say to that? Like, it kind of goes back to what you were saying before, where more or less it kind of reaches an equilibrium of, say, 45% of household income. But is this kind of like, well, we just kind of have to get over it, and something's got to change, and maybe the triple CFA could just be a convenient tool that is used to bring it back to normality? What do you say to that?
Yeah, look, I think this is a really good discussion. So I totally agree with Cameron. If any readers of my blog would know that, I've been calling the market peak for house prices for years. It's unsustainable. You can't have house prices increasing faster than incomes forever. You just can't. You can't, because you can only ever service things out of income. So if you take a long-term view of it, one would expect that, house prices, for example, would only increase as fast as incomes increase. If you back out the interest rate effect. The reality is that what's driven this market was declining interest rates, because declining interest rates decline servicing costs, which increases borrowing power. People borrow more money. And that's why you end up with these periods where you're getting, sort of debt growth way faster than income growth. Now, bear in mind that, most of us have never, sort of worked in a rising rate environment these days, because we've had 30 years of declining interest rates. So, most of us haven't really experienced what inflation was like back in the 70s, right? And the answer to that fundamentally is increasing interest rates. That is the fundamental thing that you do to solve that problem, right? And then you might go a little bit further than that and sort of say, well, look, because of issues around the broader economy, we can't do that quite yet. And that's when you see the Reserve Bank introducing things like macro-prudential tools, right? LVR restrictions, and various other things that they've been doing in the background, just sort of trying to control things a bit better whilst we're in this low rate environment. But effectively, the Reserve Bank's got the tools to get the job done. That is not, and then the government's taken it steps further. They've kind of said, well, we don't like how much money is going into residential investment property, and we think that that's causing, you know, harm. So they've kind of removed tax deductibility on residential investment property. You know, we've put foreign buyer bans in. You know, we've put a range of both, I guess, you know, sort of monetary tools, and then the government's put, you know, policy in place designed to sort of try and you know, normalize this housing market. And I think you know, for the most part, you know, these things are working. But you know, interest rates is you know, I don't know, I'm trying to think of a Lord of the Rings analogy, but you know, it's kind of the one thing that really dictates what happens in that market. It's a global thing, right? Really low interest rates globally have pushed up asset prices everywhere. This is not a New Zealand phenomenon. You can't blame the RBNZ. You know, I mean, if anything, they started increasing rates faster and before anyone else. So sorry, I've probably lost my train of thought there, but it's going on a bit of a JB rant.
That's a fantastic train of thought, though, John. I think it's great. This is awesome. But just staying on that whole political angle just for a second, I think that it's quite interesting just watching narratives of all sorts slowly evolve. And I think we'll probably continue to see that in 2022. But even our leader, Jacinda Ardern, talking about, I'll just pull this quote up on the screen for those watching. You know, even our leader is talking about bringing property prices back to levels that we were only at a year or two ago. So here we have a clear example here, or clear evidence that it is the stated intention now to bring down property prices. So my question off the back of this is, do you feel like the CCCFA is a convenient, broken, but imperfect, but convenient tool to allow the market to be brought back down? Even though it's not perfect, it will probably stay in place for a little bit longer. What do you think about that? Okay,
well, I'm going to be a little bit controversial. I do think there's a risk of house prices dropping. I don't think that CCCFA has any intention of doing this. I genuinely believe this is unintended. I think CCCFA changes have been in the pipeline for 2 or 3 years. I think it's got good intention. It was definitely designed, and I know from you know, the previous minister, Chris Farfoy, you know, he was really passionate about looking after vulnerable borrowers, and that really was the intent of it. I think the problem here is that you know, the government and I guess MB and the policymakers were given a lot of feedback that there would be unintended consequences and that it wasn't going to work particularly well, and there were concerns about it being too prescriptive. They kind of glossed over it. And I think that's partly don't really understand the financial system and the implications. They're just not close enough to it. And B, I think banks have generally not really been listened to that much lately. I think they've really found it difficult with regulators and government and policymakers because they've kind of been in the bad books in the aftermath of the Royal Commission in Australia, right? You know, we put them all through a big review, beat them up for a couple of years. I haven't really listened to them because they're self-serving. And I guess that's the challenge. You know, as a mortgage broker, I get plenty of commentary that just says, oh, he's just a mortgage broker, self-serving. He just wants to write more mortgages. And I get that. But that's not why I've been so vocal on it. I've been so vocal on it because I'm seeing the real harm. You know, we're having to dig people out of really terrible situations even now. And we just don't like seeing that.
So it's not necessarily by design. Again, underline that word unintended, right? Is what you're basically saying, is that there are unintended consequences here. It's not necessarily by design. You're going further to say that it's not like they are aware of the problem that this is causing and they're allowing it to persist to accomplish that which they explicitly want, specifically around house prices. But I'm just going to throw that back and say, hey, it's a hell of a lot easier to crash an economy than to build it up. Wouldn't you agree with that?
Yeah, well, look, that's the thing, right? Is that look, the thing about these things is it's like a super tanker. It takes a lot of effort to get it moving, and you don't necessarily know when it's slowing down. And it's really nuanced. This is the economy, but when I was in the bank, we used to talk about this with banks even. And I think the problem is that, yeah, look, you talked about it earlier. It's just when we overlay all of these things on top of each other, that's what starts to scare me. You know, it starts to scare me that none of these policies have really been allowed to let sink in.
That's right.
In terms of their consequences. And so we've just overlaid so much on this market. And, you know, and then we've just got the normal nuances of, you know, interest rates and now increasing interest rates. But that's where my concern is. It's like, and it's really about this restriction of access to credit, because that's kind of the working capital of New Zealand. That's the money that we're using to kind of sort of bumble our way through all of this risk and this changing world that we're in. And, you know, locking that up, I just think is so seriously dangerous.
We've touched on this throughout, obviously, but your general sort of gut feel on how you see this year evolving in light of this kind of pushback against some potentially unreasonable legislation, we'll call it. Do you think that any sort of pushback will be successful? Do you think this entourage effect will persist for whatever reason and do whatever it's going to do? Like, what do you think will be the ultimate outcome with house prices?
I think we will get some change there. I'm just not sure how quickly. You know, the focus really now is to get some urgent change. And I think that's important because of the harm that it's causing. I don't think the government can hide from that. There's just going to be people that are continually impacted. There's going to be plenty of stories for the media. You know, people love those human interest stories, and they're just going to keep popping up. And I think the thing is that every time someone's declined now, people are pointing at the legislation and at the government. So, you know, this is not a great situation if you're trying to win votes in middle New Zealand. So I think triple CFA will be dealt with. It will be recognised that it's a pretty major issue for them politically. And so I'm confident. I'm just not sure about the speed. In terms of house prices, yeah, look, I think there's quite a bit of risk there, to be honest. I think you are going to see some price softness. In terms of first home buyer market, I don't think you're really going to see much of it there. I think entry level prices will stabilize. But, you know, if you're in the market and you're able to buy, I think there will be some good deals out there over the next year or two. Typically in a market like this, that's what happens. You get much more balanced supply and demand, and properties start to fall through the cracks. And so if you're a hard-working buyer, deals do start to pop up. My experience of the market is generally when markets tighten up, the reason house prices don't fall much is that sellers simply exit the market. They go, oh, well, I'm just not going to sell. I'll just hold it for another couple of years. The change this time around is the removal of tax deductibility for investors. You know, there's a bigger reason for them to sell now. You know, holding it for a couple more years, you've got even less tax deductibility. So I think there's some nuances. I'm not sure how they're going to play out because I've seen examples of the bright line test that's actually making investors hold property for longer. So it's really nuanced. I think it'd be crazy to sort of try and predict that too much. Generally speaking, house prices fall when you get high levels of unemployment. Our unemployment rates, you know, the lowest in modern history, right? So very, very low unemployment rate kind of says to me that things will just stabilize. But, you know, you might get a little bit of headline reduction in parts of the country induced by higher interest rates and maybe more people needing to sell because of, you know, what's going on in their world, which, you know, I guess with tourism and things like hospitality and stuff struggling, you know, you could see patches of that in different parts of the country. Yeah, I don't know.
Yeah. No, I agree. Well, that's probably welcome news for some real estate agents across the country who've always been screaming out for new listings. But I guess if it's less comfortable for people to hang on to their property, and specifically I'm thinking about interest rates as well, right? Then they're more likely to sell rather than less likely.
You know, and again, it's just really hard with the housing market because it is so nuanced. There are so many factors that drive into it. But I think one of the big drivers of the market last year, you know, it wasn't simply just, you know, first home buyers turning up and bidding up house prices because they could afford more. I think developers had a really big role to play in this. You know, I mean, if you look at New Zealand, you know, historically we've built standalone houses. Intensifications changed the game. So, you know, if you look at pretty much, if you drive around any of the big cities now, it's all about terrace townhousing. And that fundamentally changes the economics of land. It increases land values, particularly if those townhouses can get sold for good prices. So, you know, what we've seen is you know, developers charging all around the city, buying up, you know, 800 square meter lots, paying more and more for it, which has basically significantly driven up the value of standalone houses, particularly those on subdividable land. And so much of the land subdividable now, you know, that, you know, we've seen places, using an Auckland example, Birkdale, where a place might have been 800,000 and now it's selling for 1.3 to 1.4 million, 1.5 million to a developer, because they're going to put 7 or 8 townhouses on it. You know, so I think this sort of shift in density, increasing standalone house values has been a massive driver last year. Now, if you think about that in the context of where we're at now with massive supply shortages and real challenges in the construction sector, you know, that part of the market is really starting to struggle. And I think that will have flow down impacts on the housing market, because I think it's going to be increasingly difficult for developers to justify the prices that they were paying last year for land. You know, it's not going to work with lower affordability for end buyers, higher construction costs. It's got to have an impact on pre-development land values. And I think that's certainly a part of the market where I expect to see some softness.
That's a really, really good point. All right, now as we finish up, there's something that really caught my eye that you started off towards the end of the year, and I want you to speak to this. And it's really an important call to action, I think, to those that are listening and watching. Can you talk to me about this petition that I'm looking at here around urgently requesting a rework to the responsible lending changes that restrict access to credit?
Yeah, so started a parliamentary petition. I think that was off the back of a long lunch. A journalist rang me and I said I should start a petition, so then I had to. It's actually been an incredibly effective tool, because we had about 200,000 reads of the original petition. This is a revised version of it now that's up for Parliament. So look, it just helps keep the dialogue public, and it keeps people talking about it. So I would love, if anyone hasn't signed it yet, I'd love them to sign it, share it, talk about it. You know, we'll start promoting that shortly, and just keep the conversation live.
No, that's good. That's good. All right. And then as we finish up, I didn't really even ask you to introduce yourself and what you do, but I just said that you're from Squirrel. So tell me a little bit, just, you know, we don't have a huge amount of time left, but tell me a little bit about what Squirrel does, and especially on the investment side, because I'm intrigued with what you're doing there. Quite innovative, and you're blazing a trail to some pretty interesting places. You always have been. So this is quite interesting to watch this.
Oh, look, so we're a mortgage broker fundamentally, but also a lender. And, you know, we tend to, our products that we lend on tend to be a little bit more innovative, niche, sort of trying to address parts of the market where it's broken. And so, so we've got a home loan product, we've got a residential construction product, and sort of a consumer product that we do lending on. And of course, the opportunity with us is we're one of the only mortgage funds that's available to retail investors. So at the moment, you can invest into those first mortgages via our peer-to-peer platform, and which is great. Or if you want to go through a managed fund on the Invest Now platform, there is our income fund, which fundamentally is investing into residential mortgages and just providing a regular cash income. You know, I guess the benefit of these products is regular income, and the fact that it's backed by, you know, residential mortgage security, which gives it, you know, high levels of protection.
No, that's cool. And I'm going to put some links in the show notes for those that are borrowers or investors. Just check it out. There's so many interesting little things there. So perhaps that's something that we can kind of dig into a little bit more later on another show, John. I'd really appreciate your time on that one. So again, thank you very much, John, for sharing with me. Hope you enjoy the rest of your week, and we'll catch up with you soon.
Yeah, awesome. Hey, thanks, Darcy. Nice having a chat.
Cool. Take care.
Cheers, mate.